Hi everyone, thanks for joining us for our Net Wealth Portfolio Construction webinar. I'm Jo from the marketing team at Net Wealth today, and we're delighted to have Charlie Lanchester join us from BlackRock. Before I hand over to Charlie, I'll run through some quick housekeeping. Financial advisors who've joined will receive 1 CPD point. To receive this point, you'll need to be online for at least 30 minutes. You'll then receive your CPD details within the week. This webinar is being recorded and everyone will receive a copy of the session and slides via email within the week. You can also submit questions via the question tab in the toolbar to the right of your screen, and we'll have time to answer some at the end of the session. Please be aware that the information today is general advice only and isn't intended to be professional financial advice. For those of you who don't know Net Wealth, we're an ASX listed company nearing our 20th year, and our purpose is to help Australians see wealth differently and discover a brighter future. We provide investors with a range of investment and super solutions via our platform, and investors can manage their super and investments using our portfolio tools, access a range of reports and online charts to analyse their portfolio, and stay up to date with changes in the market by accessing live prices and charts on individual stocks. Our platform also supports financial advisors with a range of financial products and services to help manage their clients' investments and super. I now have the pleasure of introducing Charlie Lanchester. Charlie is the Portfolio Manager for BlackRock Concentrated Industrial Share Fund and was previously a long-standing member of the Australian Equities team at Perpetual. Charlie began his career in London in 1992, where he worked at Schroeder Investment Management as a UK analyst. I'll now hand over to Charlie.
Thanks very much, Jo, and thanks everyone for joining this webinar. Today I'm going to talk to you about the X factor for driving returns in Australian equities. The X factor in terms of differentiation and why we are different in what I think is a new and exciting offering in the Australian equity space. And the X factor in terms of what we exclude from our investment universe to drive a more balanced portfolio for your Australian equities exposure. As Jo mentioned, I was at Perpetual for many years and ran the industrial share fund there for a decade. This is very much a new and improved industrial share fund, if you like. And before I get into a market update, just maybe taking a step back about, and thinking why I joined BlackRock. And really in a nutshell, this is a new strategy, it's a boutique strategy, it's relatively small and nimble. We currently have around 800 million of assets in the fund, mostly retail denominated, but we have the support of the world's largest fund manager. And that scale brings us, I think, some significant advantages as we go about looking for the best stocks in the market. So before I get on to talk about some individual stock stories, which may be, I think, of interest and the process that we follow at BlackRock, I will just initially give a broad market update. Certainly the market has been very macro driven over the last 12 months. And this chart really shows just how well the market has performed in recent times, at the same time as we have seen really earnings disappointing. Outside of resources that have been quite strong with the iron ore price, we have seen a number of downgrades in recent times, whether it be Caltex, Challenger, Link, Incitec Pivot, Kmart as part of Wesfarmers, Reliance, Flight Centre, Speedcast, Perpetual even. We are seeing downgrades across the market, which you can see this red line, orange line has tracked sideways, while the market in itself has gone up quite a lot. So why is this? It's all about the discount rate. As you can see, bond yields have collapsed in recent times. And in fact, the RBA has suddenly changed tack very significantly over the last couple of months and started reducing interest rates, which have been on hold for a very long period of time. Australia has now joined the party of super low rates that has been spreading around the world since the GFC. But why has the RBA dramatically changed its tune? despite the election result, which has seen a bit of a pickup in activity and perhaps stopped house prices declining as much as they had done, the economy is clearly soft, as evidenced by some of those downgrades which I already alluded to. Building approvals have fallen, the NAB hiring intentions survey is down, and wages across the board are not really moving up in the way that the RBA was hoping for probably over the last couple of years. And that is why bond yields have collapsed. And really this is driven somewhat dislocation in the market and is forcing investors to seek higher returns wherever they can find it. And so looking at this chart in another way on the next slide, we can see that the spread between bond yields and equity yields is at all-time highs, which sort of implies that the market is cheap in a relative sense. But perhaps what's not being factored in is what is around the corner. You know, what is going to happen with economic growth? What is going to happen to bank dividends if we have a bad debt cycle? And this is really, it's interesting to have a market, a stock market, which has been strong, and yet actually across the board, many investors are still very much concerned. We had that sell-off in Q4 when the market dropped quite precipitously. And I think since then, there has been, you know, we had a sudden return to volatility, which we hadn't seen for a couple of years. And since then, I think that despite the market going up so much, there's a lot of pessimism that still exists around the investment community. And really, a theme that we have seen is really two parts of the market that performed incredibly well over the last little while. And this chart shows the performance of low volatility stocks, which are defined as the top 40 stocks in the ASX 200 with the lowest share price volatility. And really, what are these stocks? These stocks are generally the larger cap stocks, which don't have some of the liquidity issues of small and mid cap stocks. They are stocks like the real estate investment trusts, infrastructure stocks, and Telstra. And you know, they are really the inverse of that collapsing bond yield. And we've seen this part of the market really take off as investors have sought out these inverted commas safe dividend yields. And really, we think that this part of the market is looking somewhat stretched right now. The other part of the market that has had a very good run, or certainly some parts of this of the market, is our Australian tech sector. Now, this is a nascent part of our index. We do actually think very positively about the tech sector in Australia. You know, if you look back 10, 15 years ago, the healthcare sector in Australia was a very small part of our index. It is now well over 10% of our index, with the success stories of companies like CSL, Cochlear, ResMed, and Sonic Healthcare. And we think that the tech sector can probably and will almost certainly be a much larger part of our overall index as we look forward in 10 years from now. And we want to play in that sector. And we do have a couple of tech names in the portfolio right now, which I'll talk about a little bit later. But in the near term, I think we are seeing, driven by these very low interest rates, a bit of a bubble in this sector, and certainly in some of the stocks. And here we compare in this chart the FANGs, in the well-known FANGs in the US. And on the right-hand side, you see how their valuations have tracked over time, going back quite a long way, versus the WAX, which is our Australian version. You'd know as the WiseTechs, the Appens, the Altiums, and the Zeros. And as you can see, just over the last year, again in this right-hand chart, our part of the tech market has really shot up, with EV to sales for some of those businesses now tracking at over 20 times, which is, as a sort of fundamental investor, something that we struggle to get our heads around. And certainly the FANGs, many of the FANGs have never traded anywhere near those particular levels. So more generally, what themes do we like in the market? Before I talk about some individual stocks, we do like the emerging market consumer. And there's ways to play this in the Australian market. Obviously, the likes of A2 and Bellamy's have been significant benefactors of this trend. We've struggled a little bit with their reliance on the Daigou channel. They're not in control of their own distribution network. And instead in the portfolio, we quite like at the moment Treasury Wine, which I'll talk about more, and Freedom Foods, which has developed a very interesting route to market in that China consumer space. We're also quite positive on the mining and oil service companies. We hold stocks like Worley, NRW, Monadelphous, Decmil in the portfolio right now. And we were recently over in Perth interviewing a lot of these companies, and we really can see solid green shoots coming through in that part of the market as the whole mining sector continues to do reasonably well. And as I mentioned, technology. We do think some of those WAC stocks are a little expensive, but we have exposure to a couple of companies, Bravura and Jentrack, which I will talk about in more detail. Themes that we would avoid or certainly be wary of. Number one, we rate there as consumer cyclicals, and I've got a chart about why we think there's some issues for that part of the market. We do feel that the Australian consumer is over leveraged based on the amount of lending that the banks have done into the property sector. That sector is clearly softening. It has stabilised, as I mentioned, but clearly the wealth effect of rising property prices is something that is not going to happen, I think, in the near term, as the banks post-Royal Commission are having to rein in their lending practices. And so we're reasonably cautious around consumer cyclicals, the super retails, JB Hi-Fi, Myers of this world, on the demand side, and in addition, they also had some issues around wage inflation coming through. In a similar vein, we are cautious around the retail REITs. I think online retail will continue to grow in this country. For a nation that is extremely adopting of technology and smartphones, we are actually behind the curve in terms of online retail, but there are signs that is continuing to grow and will hurt some of these retail landlords. Some of that is, I think, captured in the prices of the likes of Scentre Group and Vicinity, but we still think as a long-term theme, those areas will struggle, particularly the B-grade shopping centres in Australia. And finally, and we'll talk more about our strategy and the X factor that I mentioned at the start, but we are very keen to really focus our stock picking on the small and mid-cap companies that are reinvesting capital well, that are growing their business, and probably less so on the top 20 stocks in Australia, which we see maybe somewhat as complacent oligopolies. These companies in the past have been big players in a small market. They've been geographically protected by being a long way away from other parts of the world. But in the global world that we now live in with tech disruption, we think that the likes of domestic banks, insurers, and even supermarkets will struggle as we see more competition coming into those sectors. So what is our X factor? And these two pie charts really give some explanation. On the left-hand side, you see the balance of the ASX 300 as it currently stands. And when I designed this product, and it was a great privilege to come to BlackRock to really start up a new Australian equities active fundamental business, was to be able to design a product that I really believed in and wanted to invest my own money in, which I do. So I'm aligned with all investors in the fund. And a big part of that was to take away the concentration risk that exists in the Australian market. Obviously, BHP and Rio make up a big chunk of the resources sector, and we don't invest in resources directly. That's partly to diversify away, and also partly because I think it's quite hard to pick commodity prices. But probably more importantly, the banks. The banks make up almost a quarter of our index in Australia, and effectively they are one stock. Whether you're in NAB, ANZ, CBA or Westpac, they are all increasingly and have become mortgage banks in Australia. That's where they derive most of their profits from. And so to have plus or minus a quarter of your money in an Aussie equity fund in one stock, to me, just does not make sense. And so we exclude the top 5 industrial stocks from our universe as well. And as you can see on the right-hand side of the chart, that leads to a much more balanced portfolio as a starting point for building our fund. And it also means that we don't really worry about index weights. We are a very active manager. That is the other thing about this fund, is that we are running it like we would run our own money. There are the top 10 stocks in our fund, which I'll show you later on in the presentation, make up and have made up between 50 and 60% of the fund. So it's a highly concentrated product. And this chart really gives you a better feel for how we invest, and it shows our investment sweet spot. It takes a little bit of explaining, so there is no y-axis, which is slightly confusing, and it is not to scale. But what it does give you an idea of the number of stocks in the fund and the size of those positions. The yellow dots actually bring to life some of the actual names in the fund. But really, what we're looking to do, and the whole point for me of equity investing, is to try and find companies that are established. They've been listed for a little while. They may have grown to a market cap of around $300 million to $1 billion, and they are reinvesting capital back into the business. They pay a dividend, maybe 2-3% dividend, but then the capital they don't pay as dividends, they're reinvesting back into what they have, hopefully a good business model, which generates returns above their cost of capital. So we are searching and scouring the market, often in that small cap part of the market below the ASX 100, to find new ideas with good management teams. And then ideally we will stick with those companies as they progress from left to right and grow and become larger companies over time. And as you can see, the only company we own currently in the fund that's over $20 billion is ResMed. And that's a stock actually that I've owned for over 15 years in various funds that I've managed. And it's a fantastic example of an Australian company, although now based in the US, that has reinvested back into its business. It's consistently spent more research and development than its competitors, and is now the global leader in the treatment of sleep apnea and online connected healthcare in the US and in fact globally. And that's a great example. When I first invested in it, it was over on the left-hand side of this chart. I think the other good thing about our fund is when we find one of those great small businesses, if it does cross over into the top 100 and crosses that green line, unlike a small cap manager, we do not need to sell it, and we will, definitely continue to hold if it's doing well and beating our expectations. I'll now get into some individual stock stories and some of the reasons that we like individual companies. And this chart, before I go there, probably just gives and backs up my example previously about why we are cautious on domestic retailers. We don't hold any of the bricks and mortar retailers currently, and whilst we think, as I mentioned, the demand side is weakening as property prices have fallen and wage growth is minimal, there is actually some wage growth that will come through in this sector as these EBAs that have been negotiated roll off. And for a number of companies in retail, it makes quite a big difference to their P&L. Treasury Wine is a company that we've owned since we started the fund 3.5 years ago. It's followed actually by my co-portfolio manager, Madeline Beaumont, who came back from working in the UK for many years, and it's fantastic to have a fund manager of her experience look at a company like Treasury Wine with fresh eyes and also global drinks experience. And I think a lot of Australian investors back in 2014, 15, 16 were very jaded around Treasury Wine and somewhat blinkered after the experience of seeing it so poorly run when it was within Foster's and run a bit like a beer company. But when Maddie started looking at the stock, she saw that actually return on capital back in 2015, 16 was only 4%. And in fact, their inventory of good wine was very much underappreciated by the market. In addition, a new CEO came in, Michael Clark, who she'd actually had some exposure to previously, and he's done a fantastic job of really defining Treasury as a branded goods company, which gives it pricing power. In addition, wine production is at a 15-year agricultural cycle, and we are currently quite close to the lows. In Australia, for example, luxury wine has fallen 20% since its peak in 2006, and TWE has invested through that period and has 1.1 billion in luxury wine inventory right now, which underpins earnings for the next few years. They've also done a great job of growing their brand and distribution in China. And again, coming back to management teams reinvesting capital well, Michael Clark has done a fantastic job of going direct to wholesalers and to consumers, unlike many of his competitors in China, which has built up a real barrier to entry and competitive advantage for TWE, and is one of the reasons why Penfolds is such a well-known brand in China. And as you can see, there's a lot more to go. And despite the fact that there are, clearly concerns around trade war at the moment, which is one of the reasons the share price has come back recently, this direct distribution model has a long way to go in terms of geographic footprint. And these are TWE's plans for the next 3 years. Another stock in the fund which has done quite well this calendar year but struggled last year following the takeover of Fairfax is Nine Entertainment. And I think it's a misunderstood business. They have actually developed a multi-platform digital media business and have strong relationships with the top 100 advertisers across all platforms. And it's no longer newspapers and free-to-air television. Within this business now, there is also Stan, the streaming business, which is doing incredibly well, and Domain, the property business that is taking on REA, which is clearly at the bottom of the cycle right now, but we think can recover over the next few years. So it's kind of a sum of the parts valuation within Channel 9, and I think a lot of investors dismiss it based on newspapers and free-to-air television, which they think over time will go to nothing. The reality is actually in newspapers that Fairfax or Nine, as it now is, no longer print any of their own newspapers, and their digital streaming, digital media is growing much faster. And this is a growing business, trading on 14 times with a 6% dividend yield, and we think still, even at close to $2 now, it represents good value. Worley is another interesting one. As I mentioned, we are quite positive on the capex cycle for some of these mining service businesses, and as you can see here from the chart, Worley had a precipitous fall at the end of last year when the oil price fell 40% in the space of 6 weeks, and it was just at the same time as they did a massive deal to buy Jacobs Engineering, or a division of Jacobs Engineering business, which doubled the size of Worley. We actually think that deal is still a fantastic deal. It's 20% EPS accretive on our numbers, and there will revenue synergies as well as cost synergies are likely to come through over the next 12 months. Worley is the largest servicing business for upstream hydrocarbons, and it's the global leader in providing professional services to the energy, resources, and complex process industries. Currently, capex remains close to bottom of the cycle, and I've got some charts to talk about that in a minute, and the stock has derated significantly. The fundamentals are attractive. Demand is growing, both for oil and gas and renewables, and oil depletion rates are increasing, leading to a growing supply gap. Worley does trade up and down with the oil price, but we think it really shouldn't. As you can see from this chart, post the acquisition of Jacobs' business, energy only makes up 47% of the business. And in fact, major capital projects, the top part of this chart, only make up 13% of their business. 43% comes from modifications and sustaining capex, and 44% from OPEX. So it's a much more sustainable business, we believe, than it has been in the past, and therefore really should trade on a higher multiple. And this chart shows in the oil and gas sector just how much capex collapsed in 2016, 17, and 18. If you look at the top two charts, and then if you look at the bottom chart, the dotted line at the top shows the two methods of forecasting how much oil and gas will be required over the next, very much long term. And then you can also see just how, if there's no capex spent, just how quickly the depleting nature of this commodity is, and how it drops off after 2020 quite quickly. So we believe capex will come back, and Worley now, as clearly the #1 player in this market, will benefit over the next 2, 3, 4, 5 years. I alluded to Jentrack early on. It's one of our tech investments that we really like at the moment. It's a software company. You may not have heard of it. It's listed in New Zealand. It's a software company that provides business critical and embedded software solutions to the electricity, water and gas utilities, as well as airports. Jentrack have entered markets where deregulation is driving growth and now has offices in New Zealand, Australia, UK, Singapore and the US. It's transitioning its customers into a SaaS model, and it has more than 70% of its revenues in that SaaS model and annually recurring right now. A similar type of SaaS business, it would trade on 10 or 15 times sales in the US, which is certainly not reflected in the current Jentrack share price. Brexit uncertainty, they do have a big UK business, at a time when they were heavily reinvesting in that platform, has led to a temporary margin compression. And that's why the shares have come off over the last year or so, which we think creates a huge opportunity to buy into this business at a reasonable price. Because it had that little hiccup at that particular time, it hasn't been caught up in the tech bubble that I mentioned before that we've seen here in Australia. And again, I think that really provides a huge opportunity. As you can see here in the UK, this is an example of how they grow their business. Energy markets deregulated over there, and there's been increased competition away from the big six. Jentrack's ability to serve those customers on a per head basis in a very low cost manner means that they are gaining market share across a whole range of these brands. The water market as well is due for deregulation in 2020, and they'll be able to use their billing platform for that in addition. So a lot of growth, very low churn from their existing customers who are very happy with the service and reasonably priced. It's a great combination. And my final stock example is our sort of other tech business that we really like in the portfolio, Bravura. The stock has recently come off a little bit actually, so to update this chart, it's come back to a bit below $5 in the fours post the they were trying to buy GBST, one of their competitors, and two other potential acquirers have come into the fray and bid substantially more than they were willing to offer. It's pleasing that they have held their ground and not paid up for that particular business. But we still think just even without that acquisition, this is very well placed to grow earnings. And again, it's a SaaS type model, which we really like. They are positioned in the wealth management, life insurance and funds administration software industries, mainly based in the UK, but has 12 offices across Australia, New Zealand, UK, Europe, Africa and Asia. And it has in excess of 2.8 trillion of assets entrusted to its systems. It's called Sonata, and its product suite is for the wealth management and fund administration. It has net cash on balance sheet and is growing very strongly, again with recurring revenues, a little bit like Jentrack. As you can see here, the red portion at the bottom of these charts is growing strongly, as are the license fees as well, which are recurring in nature. So this is a very stable, predictable business in a growing market. And again, unlike some of the other companies, has slightly missed out on the tech boom that we've seen, and the valuations seem to us, certainly where they are today, very reasonable. So why the BlackRock Concentrated Industrial Share Fund? I mean, hopefully I've given you a flavour for the fact that we are different. We're not a small cap fund, we're not a mid cap fund, we're not a big cap fund. We will have a flavour of everything, but what we're really looking for is edge and insight. And I think being part of BlackRock, running a small fund, but being part of BlackRock, we have every advantage to try and do that. We're concentrated, which I mentioned already. We are nimble, and yet we can exploit market inefficiencies with the support of the world's largest fund manager. So what is our investment process? We have 5 quality filters, and we simply won't invest in any business that doesn't pass these filters. And this really is about avoiding the blow-ups. We look at management, we look at debt levels, we look at the ability to make a profit, We look at competitive advantage that a business has, which must be easily understood, and we look at environmental, social, and governance issues. We're certainly not looking to pick the best companies around ESG, but we will exclude those that really fail and throw up a number of red flags. And once a stock passes all of these 5 filters, it goes into our investable universe, and then we are quite flexible. You know, there's around 200 stocks that sit within our investable universe. We'll look at 60 to 80 of those in a lot of detail, which feeds down into our portfolio of 20 to 40 stocks. To be honest, since running the fund, it's been between 20 and 30 stocks, as I mentioned, with the top 10 making up 50 to 60% of the fund. So we're not growth or value or GARP, or we don't label ourselves anything. What we're really looking for is edge or insight. And look, being part of BlackRock, we do have some advantages. We have a technology platform called Aladdin, which our portfolio sits upon, which is able to measure risk in a whole range of different ways. We have a capital markets team up in Hong Kong that gives us access to every IPO, every block trade, every placement that comes through the market, and we are always on the register by virtue of our index business that we have at BlackRock, which many of you will know BlackRock for. We have access to not just deals, but also the ability to go and visit the companies that we invest in. Even though we are a relatively small fund in the scheme of Aussie equity managers, I have better access now than I had when I was at Perpetual, by virtue of us always being there on the register of these businesses. And it's a huge advantage when we're trying to find and evaluate companies that are investing capital well for the future. So here are our top 10 holdings, and you can see the spread on the pie chart on the right. As I mentioned, index unaware. I think you'll find these top 10 holdings, many of these stocks you will know, but it's a very different top 10 to most other Aussie equity managers. There's no Suncorp or IAG. There's no Woolworths or Coles. There are no banks. So the traditional top 10 that you might see in a big cap fund are just not there. And we think that drives a much more balanced portfolio. As I mentioned at the start, we are cautious on the short-term economic outlook here in Australia. And as you can see, whether it's an Amcor, Aristocrat, Boral with half its earnings offshore, ResMed, Sonic, Treasury, or Worley, these are all companies with very large global businesses that operate outside of Australia. And so we think it is, this portfolio is giving you a very different flavour to your average Aussie equity fund, and it is highly concentrated. In effect, BlackRock has 2 businesses. We have an index fund at one end of the bell curve, which is very attractive to investors and very low fee. And then, in a sense, we are right up the other end of the bell curve, making very active decisions and spending a lot of time going out and trying to find individual businesses that we can back for the long term. As I mentioned, the fund is relatively new, which I think makes it exciting. You should always back new fund managers. They're much hungrier, I think, and dynamic perhaps than fund managers that have been around for many years at the same shop. Obviously, I've been around doing this job for a long time, but this is a new endeavour. This is a new fund. There are 4 of us on the team running it. We are very much enjoying being part of BlackRock. As I mentioned, it feels like it's a boutique that we're building, yet supported by this massive entity, which gives us some huge advantages. And since inception, the fund pre-fees has done just over 13% per annum, 3.5 years in. These are some of the names that have outperformed and underperformed. On the underperforming side, QMS Media and Experience Co are still in the fund. The other ones have gone. And here are the team, which I might just talk about very briefly. As I mentioned, I brought up Maddie Beaumont before. fantastic to have someone of her experience and also global experience come back to Australia and look at Aussie stocks. I think that's been incredibly helpful. Sam was our first hire. Maddie and I joined together. He was the #1 ranked analyst at UBS, which has probably been Australia's, or has been Australia's preeminent broking firm of the last 15 years. And Nick, I brought with me from Perpetual, and he was one of their rising stars on the analyst side. So I think the other benefit to me of coming to BlackRock was the ability to hire a really A-grade team. I think investment teams, small ones are better than big ones, and having 100% hit rate in terms of high quality is really important. It's a team sport. It's not. I don't believe in star fund managers. It's all about how the four of us interact and challenge each other to come up with the best possible ideas for the portfolio.
Cool. Thank you, Charlie. That was really, really good. We'll go to some questions. So I'll just wait a moment to see if anybody has any. Feel free to send them now. And we'll wait on the line for a moment. Okay, so I've just got a few questions now. What about logistical companies? Sorry. Not sure if that's a typo or not.
Please explain SaaS. Why don't I do that one? Okay. That means software as a service. Australia's most famous software as a service company is Atlassian, which you guys will all have read about in the newspapers. Unfortunately, not listed in Australia, listed on NASDAQ, which was a great shame. Now, I think a $50 billion company. But software as a service effectively is it's an ability to buy a software package and pay for it on a service model. So you might download a particular software application and then you pay for it on a per user per month basis. And that's how you define software as a service.
Sorry, that was a typo. What about logistical companies?
Yeah, look, within Australia, I mean, as I said, it's reasonably narrow index. I mean, logistics companies, you would mean something like a Brambles, which currently we don't own. We think that the cash flow, the true cash flow in the business does not reflect what they report as earnings due to some of their accounting practices around their pallets that they depreciate. But that said, it does have a global business which is exposed to broader economic growth, and at the right price, we would look at being a bit more interested in that stock.
Okay, thank you. When selecting companies, what is the key criteria that makes it into or keeps it out of the portfolio, e.g. yield, after tax yield, etc.?
Yeah, look, it's hard to generalize because, as I mentioned, we're quite flexible. So what we're really looking for is insight. When we buy a stock, yes, we'll look at the yield, the PE, the cash return on cash invested, which is something we get from Holt, which I really like. I think you have to look at those underlying cash flows as opposed to reported earnings. But probably, most importantly, you are also assessing management. Any company has a dividend yield at a snapshot in time, but far more important is the ability of management to reinvest back into the business, which I keep talking about. But if you get that right, the compounding effect of finding those companies is incredibly valuable. So judging management and how they behave, how they're structured on remuneration, that to us is incredibly important. And if I had to pick one factor, that would be it, albeit that for various other companies, it might be a particularly attractive dividend yield, or it might be an attractive PE at some point as well. But if I had to say one thing, it would be making a judgment call around management.
Thank you. We've had a few questions regarding fees. Please explain your fee model and performance fees.
Sure. Yeah, look, we are, I mean, obviously we have iShares at one end of the spectrum, very low fees. And as I mentioned, this is somewhat of a premium product, to be honest, because we do get access to deal flow and management and have, I think, a very good team now. And there's a lot that goes with BlackRock that effectively you're paying for if you're in this fund. Now, that said, we are a small fund, and it will sound strange, but we intend to stay quite small. So this fund is capacity. It will be capacity constrained. As I mentioned, we're currently around 800 million of assets. When we started the fund, we did some capacity analysis, and so even at its peak, we thought back then around 3 billion would be the max that we manage, which again sounds strange coming from someone at BlackRock, but this will be always a relatively small and nimble product, because first and foremost we want to make sure that we can perform. So the headline fee on this fund is 85 basis points, and there's a 15% performance fee once we get back to our high water mark.
Very good. Thank you. And we've had a few questions about afterpay services and those kind of companies.
Yes. Yes, sadly, we have not owned Afterpay since its inception 4 years ago. We have looked at it very closely. It's been a phenomenal success story, and there's no question that the management have done a great job of getting their particular mode of payment out into the market. But we cannot get to the valuation right now, even if they dominate the American market. We just can't see how they would justify the valuation that we're seeing right now. Xero is another company that's been mentioned. We really like Xero. I think Xero does have the potential to be significantly larger than it currently is, but trading on a very high price to sales multiple right now. Again, it's not in the portfolio, but it's a company that, if there was some sort of pullback in tech names, would be certainly one that we'd be looking to add to the portfolio. It's a very well managed business and has some huge growth potential, particularly in the UK.
Thank you. Here's another one. Can you clarify the inception date of the fund? If fairly new, how do you provide returns? And in simple terms, can you describe briefly how you measure returns?
Yeah, the fund started officially on the 9th of December 2015. So we're 3.5 years in. As I mentioned, that still feels like to us relatively early days. And we simply measure it as in a capital and dividend accumulation method, as all other funds would do.
Does CSL have a good growth projection, and do you hold this in your portfolio?
That is a good question, because we have as the fund is described, it is the ASX 300 X5. Now, the X5, when we started the fund, was the 4 banks and Telstra, and so we have designed this very much for retail investors. At the time, the last thing we thought that they needed was me or our fund to buy another bank share or a Telstra share. Unfortunately, Telstra did so badly and CSL did so well, and we owned CSL at the time, that Telstra fell out of the top 5 and CSL has gone in. So we currently don't own CSL. I do think it's been without doubt the best performing company in Australia over the last 20 years. And I think that still has good potential ahead of it. That said, that is not an underappreciated fact. Everyone knows just how good CSL is. It's on a very high multiple of earnings. And so we don't feel left out by not being able to own it. As I sort of alluded to in that sort of chart that showed where our investment sweet spot is, we're trying to find the next CSL. We want to find that sort of company much earlier in its development and stick with it for many years. And if one of our companies happens to go into the top 5, we're more than happy with that situation.
Absolutely. I'll go to one more question now. Do you see black swan events in the world markets, or any black swan events? And if so, what would be the effect on the fund?
Yes, look, it's always very easy to read macro articles and get pessimistic. I think the pessimistic commentators always sound smarter than the optimistic ones. There's some very interesting article released today, actually, I was reading this morning from Ray Dalio, who in terms of macroeconomics is incredible. He's an incredible student of the markets. And if you read his analysis, it's on LinkedIn if you want to go and have a look for it. You can become very concerned about where all of these low interest rates and debt levels end up at some point. That said, if you look at markets over very long periods of time, you are rewarded for staying in markets. And I think it's very hard to time these black swan events. I think you have to be prepared for them and have balanced portfolios. But actually, over the long term, I'm very confident that investing in Australia and Australian equities is a great place to be, particularly relative to other parts of the world. We have immigration, we have natural resources which are bolstering our government coffers right now. We have, it's a place that people actually want to live. We've got an education system, a healthcare system, which is the envy of the world, and a superannuation system, which is ahead of most parts of the world. So it's on a 10-year view, which is my time frame for running this fund at a minimum. I think being in Aussie equities is going to be a great place to be.
Thank you. Actually, there's one more question that I think everyone will be really interested in. Just generally, what are your thoughts on the current state of the global economy? And what is your outlook for global and domestic equities?
That's a big question. I look at, at BlackRock, we get a lot of this stuff, and I guess if any of you have access to the BlackRock Investment Institute documents, they will probably give you a much broader and defined view on this. But actually, I think the BlackRock view of global markets and the US economy in particular is things are not quite as bad as people are predicting. There are talks of more rate cuts, coming through in the US, and I guess BlackRock's view is actually the economy is stronger than people think. So that would be their slightly out of consensus view. And the Australian market, or Australian economy, as I say, I think we are cautious. As a team, we think that house prices can still fall further. I think there's potential for a bad debt cycle to some extent within our banking system. Bad debts are at record lows, but I think that many people have borrowed too much money. And so in the short term, I think that does have some potential weakening effects, which is what I think the RBA has seen and has forced them to drop rates twice over the last couple of months.
Great. Thanks for your time there and answering all those questions. Thanks everyone for joining us. As a reminder, if you've been online for at least 30 minutes, you'll receive your CPD points and the slides within the week. In case you're interested, you can view all of our managed funds and their performance on our platform, including BlackRock. We'll also send out a link to this in the slides by visiting our compare funds and models page, which can be found on our website. And we also have a podcast where we pick the brains of wealth professionals to uncover insights and opportunities for your portfolio construction. Charlie's just about to record one soon, so look out for that coming up. Thanks again, everyone.